Chapter 9 is all about receivables. We've been over it before, but just as a little refresher, receivables are all money claims against other entities, and they usually make up a significant portion of current assets. So you're already familiar with accounts receivables, which is what happens when merchandise or a service is sold on account. And these are normally collected within 30 to 60 days. We also have what's called notes receivables, and these are amounts customers owe for which a formal written note has been issued, and it's normally used for credit periods of more than 60 days. So a note is more of a formal promise compared to accounts receivables, but both of those make up a significant portion of current assets. As you can probably imagine, companies have cash, but they also have a lot of customers that pay on account, so they have a lot of accounts receivables. Because customers are paying on account and they're not paying cash right away, there is the risk that some customers will simply not pay their accounts, making the receivables uncollectible. So since they're paying on account, once again, they're not paying you cash right away, so you have it written as a current asset because you're expecting to get cash from that customer, but they could simply not pay you. So the receivable becomes uncollectible, and that is an expense for you, but we'll get into that in a little bit. Some indications that an account may be uncollectible include if the receivable is past due. So if you were supposed to be paid in, let's say 30 days, it's been 40 days, that might be a cause for concern. If the customer does not respond to collection attempts, that also might be a problem. If the customer files for bankruptcy, that might be another sign that the account might be uncollectible. But we can't say there's any one thing for certain, but these are all possible indications that an account may be uncollectible. So as I was saying earlier, if the customer doesn't pay and the receivable is uncollectible, that's an expense for you, and we call it bad debt expense. Bad debt expense is the operating expense recorded from uncollectible receivables. It is the expense associated with writing off a receivable. So you're acknowledging the fact that you didn't get paid, you gave that person a product or a service, and they said they were going to pay you, but they didn't actually, so that's an expense for you, and that process of acknowledging it is called writing off the receivable, and you would record bad debt expense as a result. So there are two methods for accounting for uncollectible receivables. The first is the direct write-off method. In the direct write-off method, we record bad debt expense only when an account is determined to be worthless. So we have to be able to specifically identify the account and say, Devin's account, she went bankrupt, she's not going to pay me, it's very clear, and when you identified my specific account and the amount in it, you would write it off directly. This is used by small companies with few receivables because, as you can imagine, if you're a large company, you have tons and tons of receivables, and it'd be really hard to keep track of every single one, the amounts and everything else, and then write them off directly. It'd be hard to keep track of. So instead, there's what's called the allowance method. So the allowance method records bad debt expense by estimating uncollectible accounts at the end of the accounting period, and then after that, we write off accounts as they become uncollectible. So we are going to do an estimating entry at the end of the period, and then the next period, as they become uncollectible, then we'll write them off. The allowance method is required by GAAP for companies with many receivables. So, main difference, direct write-off method, we are recording bad debt expense when an account is determined to be worthless. Under the allowance method, we do an estimating entry, and then we write accounts off as they become uncollectible in the next period, and I'll show you the different accounts that are associated with that. Direct write-off method is used by small companies with few receivables, and the allowance method is required by GAAP for companies with many receivables. Okay, so we're going to focus on the direct write-off method first. So with the direct write-off method, bad debt expense is not recorded until the customer's account is determined to be worthless. at that time, the specific customer's account will be written off. So as soon as you can identify that it is worthless, then you'll write it off. How do you write it off? You are going to debit bad debt expense. Bad debt expense is an expense account, so we debit it to increase. And we're going to credit accounts receivables to take it off our books. Because we're saying it's uncollectible, it's worthless, accounts receivables normally has a debit balance, we're crediting it to get it off of our books. So in the example we see down below, on December 1st, a $5,000 accounts receivable from Joe Smith is determined to be uncollectible. So what we are going to do, we are simply going to debit bad debt expense for $5,000. We're debiting it to increase, and then we are going to credit accounts receivable Joe Smith for $5,000. So we are taking Joe Smith's accounts receivable off of our books, and we are acknowledging the fact that it's uncollectible, and we're incurring an expense for that. So that is our entry for direct write-off method. It's the more simple method of the two. So we just debit bad debt expense and credit accounts receivable. Now we're going to talk about the allowance method. The allowance method estimates the uncollectible accounts receivable at the end of the accounting period. So it's done via adjusting entry. So down below, I show you that bad debt expense is recorded by an adjusting entry, and we have another account that we'll be working with, and that's called the allowance for doubtful accounts account. And this is a contra asset account. So if you remember, contra accounts are contrary to their related account, and they'll have the opposite signs. So the allowance for doubtful accounts account is contrary to the accounts receivables account, meaning it'll have the opposite sign. So accounts receivable, you debit to increase, credit to decrease, and allowance for doubtful accounts, you will debit to decrease, credit to increase. So the allowance for doubtful accounts account is credited for the estimated bad debts because specific accounts cannot be identified yet. So this is going to be an account created via adjusting entry, and it's very similar, if you remember, to Chapter 6 and merchandising businesses, and how at the end of the period we created adjusting entries for customer refunds payable, and estimated returns inventory. So we do it at the end of the period, and then we draw from that account throughout the period. Okay, so down below I show you what that adjusting entry would look like, and then later I'll show you how we do the estimating process. But basically, this would be your adjusting entry. So it tells you that it is estimated that $50,000 of accounts receivable will be uncollectible next year. So later on, I'll show you the two different methods for the estimating process, but for right now, you're just going to take the $50,000 as a given. So the first step of the allowance method happens at the end of the period. So that would be December 31st, and we're going to create our adjusting entry for our estimate that will then draw from next year. So we are going to debit bad debt expense for $50,000 to reflect the fact that that's an expense. That's how many accounts we think are going to go uncollectible, so we're going to account for that up front. And then we are crediting the allowance for doubtful accounts account for $50,000 to create that account that will then draw from throughout the next year or period. So this account is going to start with a balance of $50,000 in it, and will draw from it throughout the year. And then we do this up front to make sure our expenses match our correct periods. So if the credit sales happened in 2020, you want to make sure this expense is incurred in 2020, because those accounts might go uncollectible next year, but you don't want them to cause expenses in the following year that are related to this year. Same idea as Chapter 6 that we went over before. Okay, so this next step is what you would do when you actually identify the account under the allowance method. So when a customer's account is identified as uncollectible, it is going to be written off against the allowance account. So as before we wrote it off directly, now we're going to write it off against the allowance for doubtful accounts account. So it tells us, similar example, on January 1st, John's account worth $5,000 is written off. So now what we're going to do, we are going to debit allowance for doubtful accounts for $5,000. If you remember, our allowance for doubtful accounts has an original credit balance of $50,000 that we draw from throughout the year. So when we identify an account as uncollectible, we are going to write it off against allowance for doubtful accounts. So we identified John's account, we are going to debit allowance for doubtful accounts for $5,000. And then same process as the direct write-off method, we are going to credit accounts receivable John for $5,000 to take it off our books. And then just kind of an intuitive thing for you, at the end of the period, the allowance for doubtful accounts account will have a credit balance if the estimate was higher than the actual uncollectibles, or a debit balance if lower. So it's an estimate. We had our original $50,000 estimate. If we only had $40,000 worth of accounts go uncollectible, then we'll have a credit balance at the end of the year, meaning our estimate was too high. And then vice versa, it would have a debit balance on the other hand. So it is an estimate and it won't be perfect. Okay, so now after we've been through the process of creating that adjusting entry and then writing off an account, I'm going to explain to you how we actually go about estimating uncollectibles. So there are two methods. The first is the percent of sales method. And this is, the main idea is that accounts receivables are created by credit sales, right? You sell something on account. So uncollectible accounts can be estimated as a percentage of credit sales. This is going to emphasize the income statement. So this is because bad debt expense is the focus. Our process is simply bad debt expense equals credit sales times bad debt as a percent of credit sales. And that's an industry statistic that would be published, it would be created. Maybe you realize that every year you have 1% of credit sales go uncollectible, so then you would know that statistic. So in the example, it tells us that total credit sales for the year are $1 million, and bad debt as a percentage of credit sales is 1%. Using that, your bad debt expense would simply be $1 million times 1%, so you would get this $10,000 as your bad debt expense. And once you had that, you would do your normal adjusting entry creation. So that would be bad debt expense is going to be debited for $10,000, and allowance for doubtful accounts is going to be credited for $10,000. And that is your adjusting entry. Because this process is for estimating the uncollectibles. So that is the percent of sales method. Again, it emphasizes the income statement because you are getting the value for bad debt expense, and then your allowance for doubtful accounts is just going to be the same value, and it's going to follow that. Whatever you got for bad debt expense, allowance for doubtful accounts will be the same. And we're emphasizing the income statement because we're estimating an expense. Okay, on the other hand, we've got analysis of receivables or aging the receivables. And this method allows for an estimate, which is the desired adjusted balance for the allowance for doubtful accounts. So this is the key phrase right here, desired adjusted balance. It's what we want the balance of that account to be. So really important is that the amount of the adjusting entry is the amount that will yield an adjusted balance for allowance for doubtful accounts equal to that estimated by the aging schedule. So it makes more sense if I explain it with the example, but basically This method is getting you the value of allowance for doubtful accounts, whereas percent of sales was getting you the value for bad debt expense. And this is where that earlier thing I said to you comes into play. There could be a balance in allowance for doubtful accounts at the end of the period because it is an estimate, so you might have a value in it carrying forward from period to period. So if there already is a value in the account, then your adjusting entry will not be the same as, actually, I'll just show you. So the balance of allowance for doubtful accounts is $5,000. And the estimate determined by aging the receivables is $25,000. So right away, this is what I was trying to say. You have a balance in allowance for doubtful accounts already of $5,000, meaning your estimate from the previous period was too high, so now you have a little bit left over. And then you do your whole process of aging the receivables, and you get that the desired adjusted balance is $25,000. Then what you're going to do is figure out what you need to do to allowance for doubtful accounts to make it be this $25,000. So there's already a $5,000 balance in it. To get it to be $25,000, you need to increase it by $20,000. So what I was saying earlier was that instead of it being you're just going to use the $25,000, you have to consider what's already in the account when you're making your entry. So in this case, you say, okay, there's already $5,000 in the account. I want it to be $25,000. I need to increase it by $20,000. So your adjusting entry in this case is going to be debit bad debt expense for $20,000 and credit allowance for doubtful accounts for $20,000. So whereas before we were estimating bad debt expense and then allowance for doubtful accounts followed, now we are estimating allowance for doubtful accounts. We're getting the desired adjusted balance for allowance for doubtful accounts, taking into account what was already the balance of it, and then figuring out how we get that desired adjusted balance. Then you're going to figure out how much you need to increase or decrease allowance for doubtful accounts by, get that value, credit allowance for doubtful accounts, and then bad debt expense just follows, and it's the same number as what you got for allowance for doubtful accounts. And again, this emphasizes the balance sheet, whereas percent of sales emphasizes the income statement. Okay, and then just to go over one more time, this is your adjusting entry that you make at the end of a period, and then after you have that adjusting entry, so you either did it through analysis of receivables or you did it through percent of sales method, either way you get your adjusting entry. That was this initial slide of how you get this adjusting entry. Once you have it, you could do it either way, then you do this process like normal. So the estimating doesn't affect this entry right here, it only affects your adjusting entry. Okay. And if that isn't clear, please feel free to follow up with questions. Okay, last topic is notes receivables. So just some terms first. A note is a written promise to pay the face amount of the note, usually with interest, at a date in the future. So the face amount is the amount the note is for. It could also be called par value. The issuance date is the date the note is created. The due date or maturity date is when the note is to be paid. The term is the amount of time between issuance and collection. So when you issued it to when it's due is the term. Most important probably is the interest rate. So that is the rate of interest paid on the face amount of the note. And we are going to calculate interest as the face amount times the interest rate as a percentage. So that's as a percentage. And then times the term of the note divided by 360. You could also do 365, but just for simple math purposes, it's easier to do 360. And then the maturity value is the amount paid at the due date, and that will be equal to your face amount plus any interest you owe. So that covers the content. Now we're going to do some practice problems, so hopefully this is all a little bit more clear. So it tells us, you received notice that a customer of yours with an accounts receivable balance of $500 has gone bankrupt and will not make any future payments. Assuming you use the allowance method, your entry is, so it's really important here that you know which method you're using, because as we remember, our adjusting entry is going to be different depending on whether you're using the allowance method or the direct write-off method. And your subsequent actual write-off will be different as well. But we're using the allowance method, and then it tells us that the customer has been identified. We know he went bankrupt and he's not going to make any more future payments. So what entry do we make? Well, in this case, we're doing the actual writing off of an account under the allowance method, and that is going to look like this. That'll be a debit to allowance for doubtful accounts for the $500, and it is going to be a credit to accounts receivable for that customer for $500. We are using the allowance method, so we don't write it off directly. We write it off against allowance for doubtful accounts, and we are writing it off, so we are using a credit to accounts receivables. So that gets us D. Okay. Now we have the allowance for doubtful accounts has a debit balance of $1,100 at the end of the year before adjustment, and an analysis of customers' accounts indicates uncollectible receivables of $12,900. Which of the following entries records the proper adjustment for bad debt expense? So there's a few different things going on here that we should take note of. So first of all, it tells us the analysis of customer accounts indicates. That means we are using aging the receivables. So that is the estimating method we're using. We're not using percent of sales, we're using analysis of receivables, aging the receivables, whatever you want to call it. So that's important. And then since we're using allowance for doubtful accounts, we are clearly using the allowance method. So it's important to just make sure you are clear with these things up front so you don't get yourself confused. And then the main part of this question is saying, allowance for doubtful accounts has a debit balance of $1,100 in it. So basically what that means is it's kind of got a negative balance. Not really, but we're going to write it as that. So it has a current negative balance of $1,100. And analysis of receivables told us that the balance should be a positive $12,900 because this is our desired adjusted balance for AGA. So if our desired adjusted balance is $12,900 and currently we're at a negative $1,100, we need to increase allowance for doubtful accounts first by positive $1,100 to get us to net zero, and then we need to get to $12,900. So in total, we are going to be increasing the allowance for doubtful accounts account by positive $14,000. And then it's just a matter of knowing what your adjusting entry always looks like, and your adjusting entry will always look like bad debt expense is debited for $14,000 and allowance for doubtful accounts is credited for $14,000. And that is going to be A. Okay. Now we have another example. So it tells us allowance for doubtful accounts has a debit balance of $5,500 at the end of the year before adjustment, and bad debt expense is estimated at 6% of net credit sales. If net credit sales are $800,000, the amount of the adjusting entry to record the estimate of uncollectible accounts is. So here it's a little bit tricky because they gave you a few different things and they're trying to confuse you. So allowance for doubtful accounts has a debit balance of $5,500 at the end of the year, and bad debt expense is estimated to be 6% of net credit sales. The first sentence is what you would need to know if you were using aging the receivables, but we're not going to be using that method because we don't have all the information there. Instead, we are going to be using percent of sales. So that's important to note. We're ignoring this up here. We're focused on estimating bad debt expense as a percentage of sales. And how do we do that? We use the formula that bad debt expense is equal to credit sales times bad debt as a percent of credit sales. So if we do that out, it tells us credit sales are $800,000 and bad debt is estimated at 6% of net credit sales. So times 0.06, that is going to be $48,000 as our bad debt expense. And that is going to be C. And then just in case you were curious, your adjusting entry would look like bad debt expense debited for $48,000 and allowance for doubtful accounts is credited for $48,000. Your adjusting entry will always look the same. Okay, so that handles that question. And then lastly, we have on October 1st, Black Company receives a 7% interest-bearing note from Reese Company to settle a $20,000 accounts receivable. The note is due in 6 months. At December 31st, Black should record interest revenue of. So, first important thing here is remembering our interest formula. So that is interest equals face value times interest times term divided by 360. So we can fill in some of the values now. So our interest is going to be our $20,000 face value. So it tells us that we received a note to settle a $20,000 accounts receivable. You don't need to worry about that. You just need to know that because we'll handle that in a later chapter. The account is worth $20,000. So that's the face value. And it tells us it's a 7% interest-bearing note. So we are going to multiply that by 7%. So 0.07. And then this is the tricky part. Our term divided by 360. So it tells you that the note is due in 6 months, but it's a little bit confusing because the note was issued on October 1st, and it's asking us how much interest we should record as of December 31st. And that is what you need to figure out for the term. It's not the term of the total note, it's just the term that we're looking at here. So October to December 31st is going to be 3 months because you've got October 1st to the end of October is 1 month. Then you've got the beginning of November to the end of November is another month. And then the beginning of December to the end of December is another month. So 3 months. So if we're doing a little estimating, that's going to be 90 days for the 3 months divided by 360. And that is going to get us $350 in interest. So that handles all of Chapter 9. If you have any questions at all, please feel free to reach out at any time. This chapter can get a little bit confusing with the adjusting entries and knowing percent of sales versus aging the receivables, direct versus allowance, and then everything with the notes. So any questions at all, please feel free to reach out, and I hope you have a great rest of your day.